All right, good morning, all. All right, good morning, all. Thank you for joining us today. Our seminar today is called Gifting Up, Creative Estate and Income Tax Planning Strategies for First Generation Affluent Wealth Creators. And we spent some time to figure out how to really specialize that, and we're going to take some time today to talk about that. My name is Chad Halbur. I'm with Cornerstone Private Asset Trust Company. We are an independent trust company helping families transition wealth from one generation to the next. I'm going to introduce the beginning of our presentation today, then I'm going to hand it off to a few of my colleagues to get into more of the specifics. I wanted to start by just referencing that we put a reference in on this from Ed Milet, who is a well-known podcaster and guru in self-improvement, with the concept of it being the one. And what that means is he's talking about typical blue-collar families or traditional middle-class families that have kind of continued to be successful but not have that big wealth or affluent effect in their lives. And what we feel our presentation today really addresses some of that first generation affluent wealth, and we're really excited about talking about that today. So I'm going to walk through at a high level what we're going to cover. We're going to start with Michael Andrews, who's with the accounting firm BGM Group. He specializes in trust and estates and has a lot of expertise in the area of tax planning, estate planning, and business planning too. He's going to talk about the current federal and state estate tax makeup, what our framework is today, give us a high-level overview and baseline of what we're working with as we look at trying to provide opportunities and benefits from our clients, working within the current framework and structure of the laws. Then we're going to hand it over to Chad Carr, who is an attorney with Stadig Johnson, and he is a specialist in trust and estate planning, helping draft documents, create strategies, and build wealth for our clients. He's going to get into a few topics, starting with what traditional estate planning looks like, and then we're going to kind of turn it on its head and talk more about what first generation wealth planning might look like. Because for first generation wealth planning, there's other considerations and opportunities that we want to bring into play. Well, he's going to touch on how transferring wealth to an older generation might add value to the relationship or to the tax situation, and then how to help manage and control the outcomes as we put these plans and strategies together. And then I'm going to come in and wrap up with a little oversight of how using trusts and helping control some of the outcomes can provide really good long-term benefits and outcomes for our clients. And then we'll kind of wrap up today. We do have the Q&A feature on, and if you have questions, please feel free to put a question in the Q&A section down on the bottom. We are going to try and hold that questions until the end. We think a lot of what might come up will be discussed as we go through the presentation, but we'll leave 10 to 15 minutes at the end to be able to address any questions that might come up. So to kick this off, I'm going to hand it over to Michael Andrews to talk a little bit about the current state of state and estate tax.
All right. Thank you, Chad. Well, to get things kicked off, I'll give a brief overview of the federal and Minnesota estate tax exemptions and estate planning terminology that should help grasp some of these strategies that we're going to be talking about. So I'm going to start with the federal estate tax overview and then move into the state estate tax overview. So the current federal lifetime gift, estate, and GST tax exemption is $15 million per person. So if you gift away an asset during life, you've got this $15 million exemption, or if you pass away and you've got less than $15 million of assets, and you got to add in your prior gifts, but if you have less than that, then you'll owe no estate tax. There's also a generation skipping tax, which means that if you gift to an individual that is 2 or more generations below you, then it could also be subject to a GST tax, and it has the same exemption as the gift and estate. So the current federal annual exclusion is $19,000 per person. And that is primarily for present interest gifts. So I do want to kind of explain that a little bit so you do have some knowledge. If you gift to a person outright and they have an unrestricted right to the asset, meaning they have immediate use, possession, and enjoyment, that's what qualifies for an annual exclusion. And that could be an annual exclusion for regular gift tax purposes and for GST tax purposes. Now, on the contrary, if you give a gift of a future interest, that means that someone does not have an immediate right or enjoyment. And you see this a lot when you gift a trust where that particular beneficiary or donee does not have an immediate right, then it does not qualify for an annual exclusion. And just fair warning, you could have an annual exclusion for regular gift tax purposes, but not for generation skipping tax purposes. So keep that in mind, especially if you're thinking about gifting a really large amount that's kind of on the fence of the exemption. So the top marginal rate for federal estate tax purposes is 40%. So anything over that 15 million will be taxed at 40%. And if it goes to a GST beneficiary, you could have also that additional 40% tax. So making sure that you plan for anything associated with generation skipping gifts that you don't run into those issues. So some really important terminology that we're trying to hone in on is one, portability, decedent spouse unused exemption, and this concept of step up in basis of inherited assets. So portability is where if you have a husband and wife and one passes away, you can port over that decedent spouse unused exemption. So that's that 15 million. Let's say that you have a husband and wife and husband's worth 15 million, wife is worth 10 million, and husband passes away and everything goes to the spouse. Well, if the spouse does nothing, she then has $25 million in assets. And let's say that she ultimately passes away the same year, this year. She would have $25 million in assets, less the $15 million of exemption that she would have. So she would owe estate tax on that 10 million. So that would be $4 million, the 40% times the 10 million. However, if let's say that when the husband passed away, the advisors got together and appropriately filed a portability election. So you must file a 706 to elect to port that unused exemption over to the decedent spouse. She would then have 30 million. So if she passed away in the same year, she'd have 30 million of exemption because she's got her own 15 million and then she got the 15 million from her spouse. So just be aware of that. And one thing that I do want to make sure you know is that the only thing when you do make the portability election, the unused exemption comes over. However, depending on what law is during, the second spouse to die, their exemption's changing. So you may be thinking, well, we're not even close to the 15 million, or let's say we're worth, 15 to 20 million. We're not even close to that. Well, let's say that you do get ported over the 15 million from your spouse, but the exemptions revert back to say 5 million. Well, then you're working with a lesser number for that surviving spouse. So it becomes important that you actually do give thought into this and plan for it. And your advisors come together to make a decision on whether or not it makes sense to make the portability election and have that DeSuey ported over to the surviving spouse. Another important topic that kind of hones in on some of this planning is what's called step up in basis, and that's under Code Section 1014. So what that means is that when you pass away with an asset, you get a step up in basis to the fair market value of whatever that asset is. And depending on what the asset is, you may have to get appraisals, valuations of business, and or you can go on and figure out what the high-low average is of a publicly traded stock, but that's how you value that as of date of death for that particular asset. You can't just pull a number out of a hat and say, this is what it's worth. You've got to get some type of valuation appraisal in order to justify that that is the value of the asset as of the decedent's date of death. And that step up in basis becomes really valuable. So I'll kind of give you an example. Let's say that, let's say that you have a taxpayer. He bought a stock that was 20 years ago and it was $10 a share when he bought it. Now, when he passes away, it's worth 200. So if he gifts away that asset before he passes, the beneficiary generally gets that $10 basis in that asset. So he gets what's called carryover basis. Whereas if the decedent passed away with it, it would be a step up in basis to that $200 a share. So then the beneficiary, let's say that the beneficiary wants to sell that particular asset, their tax saving is tax on that $190 because that particular person held on to it until they pass away. And I know we'll have questions, so and we're going to have that at the end. So feel free to ask any questions you may have. So jumping over to the Minnesota estate tax. So Minnesota currently has a lower exemption. It's currently at 3 million. And they also have a 3-year gift clawback rule. So under Minnesota, they don't care that you made a gift, but if you made a gift within 3 years of your death, what they do is say, hey, it was a premeditated gift, it's includable in your estate. So let's say that you have $4 million estate and you gift away $1 million, and when you pass, you're worth $3 million, but that gift was 2 years ago. Minnesota is going to bring back in that $1 million into your state, so then you would owe tax on that $1 million that you gave away within 3 years of your death. Minnesota does have a small business and farm property deduction that is up to $2 million. And, it's not as easy as it sounds, so fair warning on that. There's a lot of things that you have to hurdle over to ensure that you do qualify for those deductions. I'm mainly making you aware of it. So that way, there's some things that you may need to get in place before, a particular person passes away to ensure that you have the right things in place. So that way the beneficiary or your estate qualifies for the deduction. So be sure that you address anything that you may have as far as that goes that may be beneficial for your heirs and your estate. I put the Minnesota state tax rates here just to kind of make sure that you do focus on differences between estate and income tax rates because like we were talking about, they really do interplay with each other with a step up in basis. So as you can see, Minnesota state tax is assessed over $3 million. So these amounts are what's over 3 million. So let's say that you've got $10.1 million of assets and you take away the 3 million, that's 7.1 million. So you'd owe 13% tax on that. Now you're like, well, that'd be a lot of money, Michael. Well, I'm going to give you an example that might kind of drive in some of this concept. And like I said, this isn't a one size fits all. That's where, reviewing everything and making sure that the right steps are taken will be very important. But kind of driving in some of these concepts will be helpful. So let's say, for example, that we have a taxpayer that has $4 million or $5 million of assets, 4 million of which is in a commercial property that has been depreciated over many, many years. So his basis in that asset is relatively small. And he's got $1 million of cash. So one thing that I would say that probably will make sense is that maybe what you do is you pay the Minnesota state tax, but you get that basis adjustment to fair market value. So now you get a step up in basis. I won't say you, but your heirs do on that asset, and then they can depreciate that property, and or if they sell it, they're not going to have to recognize any gain or very little gain. And depreciation starts over once you pass away. So keep that in mind. But Again, that's something that would need to be reviewed and really sketch out the benefits of paying the estate tax and getting the step up and weighing that against gifting away the assets. So with that, we'll kind of dive into some more sophisticated planning strategies. So I'm gonna give it over to Chad Carr and he'll be able to talk about that. Thank you.
Perfect. Thank you, Michael. I'll just do a little screen share switch over here. And what we've looked at, or one of the common things, as Michael just nicely and succinctly gave to everyone, was a breakdown and rundown of the tax considerations. Now, in estate planning, one of the major things is we want to focus on the substantive. What does the family need, or what does the person or you want to do with your assets when you die or during your life? How do you want to pass on your wealth? But there is a lot of tax considerations in doing that in a tax efficient manner. And what Michael just went through very nicely was the interplay and the consideration of both estate and gift tax and income tax planning. And with our larger exemption amounts, particularly at the federal level, we're thinking more and more as how in the estate plan can we benefit the family through this income tax planning considerations like a cost basis adjustment at death and those sorts of things. I remember still, I am old enough to remember, we used to have federal exemption, estate and gift tax exemption rates at $3.5 million. Minnesota's exemption rate was $1 million. So with those levels, as estate planners, we were get assets out of the estate. We weren't even thinking about cost basis step up because we were about trying to avoid the federal estate tax, which had a 50% estate tax rate at that time. Now with larger exemptions, we're able to think more holistically about the tax planning that goes into overall estate planning. And what we have on the screen here is a summary of the traditional estate plan. Those of you that are advisors and planners yourselves have probably seen this flow chart or a similar flow chart multiple times. Those of you that maybe have done your estate plan probably got a flow chart similar to this, or maybe have seen this in your own estate planning. But this is a sample of what we look at from a traditional downstream planning from the older generation of Mr. and Mrs. Smith to their younger generation in the children. And so here in this scenario, we have Mr. Smith up at the top. He passes away. After his estate administration happens, a family trust is formed, and this is using the Minnesota exemption. Minnesota not having portability where spouses can't share their 6 million. It's a use it or lose it proposition. So the family trust or the credit shelter trust or AB trust, many different names for the same thing, uses that 3 million, upwards of potentially 5 million if you've got qualified farm property or qualified small business property, to utilize the predeceasing spouse's exemption for Minnesota estate tax purposes. The other branch comes over here to Mrs. Smith individually. And so using the marital deduction and using the DSU, you can move assets and put it over into Mrs. Smith's name or individual to avoid any estate tax if they're over $3 million from occurring on Mr. Smith's death. So this planning utilizes the Minnesota exemption, but uses the marital deduction and uses that DSU, as Michael mentioned, where the advisors would say, should we file a federal estate tax return, even if we don't have to port over or use the DSU and give Mrs. Smith 15 more million of exemption, or 12 million, I guess, because there would be 3 million used in the family trust. The other consideration, we noted some retirement assets being a major asset for many, many families, both with significant resources and those with more modest resources. So knowing the new rules under Secure and Secure 2.0 of the 10-year payouts and those sorts of things versus lifetime payouts, that's a major consideration now in income tax planning for a family of should it go to the spouse where they're an eligible designated beneficiary and have lifetime payouts, or does it go to a non-spousal beneficiary and then you're capped at 10 years and pay a lot more income tax much more rapidly? So that's just one example of income tax planning in this. Then we'll see on Mrs. Smith's death, again, assets running through her name, going through her estate or through the revocable trust, coming down to the children in this downstream planning. The family trust assets doing the same, but being outside of Mrs. Smith's estate for estate tax purposes, because they used Mr. Smith's Minnesota exemption to cover those assets and whatever they appreciated to. And so in this plan, this traditional estate plan, it's really powerful. You hit a lot of the elements of estate planning and the exemption usage that Michael just went over. Minnesota estate planning exemption or estate tax exemption, DSU to cover the assets coming down from Mrs. Smith, ultimately to the children. There being a step up in basis on Mr. Smith's death, there being another step up in basis on Mrs. Smith's death, but only to the assets here in this bucket that I'm circling, not to the family trust. I'll mention that real quickly. So then you get the children down here, whatever they inherited through this side of the line, having a full basis and can sell that for no income tax. The family trust, because you get the benefit of moving those assets outside of Mrs. Smith's estate, don't receive a second step up when she later dies and her death. They are out of her estate, so that 1014 basis adjustment that Michael talked about does not apply. But you'll see over this plan, there is a really good use of all those exclusions and exemptions and those sorts of things. But the big plan here is they're capped. They have 30 million federal exclusion or exemptions, and they've got 3 million each, 6 million if used properly, of Minnesota. What if their assets are in excess of those exemptions, either from a Minnesota estate tax or a federal estate tax? They don't have any more exemption that we can create. It's not like you can just pull DSU or exemption from other people. And if they are that one, that wealth creator that for their family that is extremely wealthy, that's coming from that family of the modest means, how do you think or plan creatively to shield anything that might be in excess of this Mr. and Smith's exemptions? And so that comes into the concept of this gifting up or upstream planning to look upwards for the plan. But effectively, the general summary of the plan is let's look for other people's exemptions and exclusion that they're otherwise not going to use. We are at 15 million per person, federal estate and gift tax exemption and exclusion amounts, 15 million GST exemption, as Michael went over. There's a lot of people that will never use their federal estate and gift tax exclusion amount or GST exemption. The historic amounts that we're dealing with is much of that is going to go wasted, or most people are never going to be in a federal taxable estate situation. But if there is that family member that has brought wealth into the overall family dynamic, then we could utilize through estate inclusion other family members' exemptions and exclusions. So really what we're looking here is who's going to waste theirs and can we use it in the wealthy family members' planning. And so this could be a sibling or it could be someone else that could be involved in this plan, but the power of the upstream planning going up a generational level, including and causing estate inclusion in mom or dad's estate to use their exemptions is more powerful because you add that income tax benefit of the cost basis step up. And what that is, as Michael said, is when someone dies owning an asset, the basis gets adjusted. And so one of the problems many times when we think of estate planning and that income tax or cost basis adjustment planning is we have to tell the client, you have to die to get that benefit, or your family has to get that benefit. Using upstream planning, the family can get the benefit without the wealthy family member dying themselves. Unfortunately, a family member does pass away, obviously, in the older generation, but that is utilizing that ability or the likelihood the older generation will pass away first and accelerate that step up in basis so that the current family can continue to live and utilize the income tax benefit of selling the asset at no income tax or capital gains tax. Or, as Michael noted, one of the more powerful tools is if it's not an asset like a real estate or a asset used in business, you get a new depreciation schedule that you can now redepreciate. That since you've depreciated it down to zero, you get a new schedule, redepreciate it. That can save significant income tax dollars over the lifetime of that asset or the business. And so that's the overall concept of that upstream planning is one, how do we utilize the estate and gift tax and GST exemptions of the older generation? And how do we utilize that to strengthen or empower the family to do some income tax planning utilizing that cost basis adjustment? And here's I think flow charts, particularly dealing with estate plan, are really powerful. So here's a very simple flow chart to kind of hopefully show how this works. So we've got generation one here. This is our wealthy family member that has come from modest means or relatively modest means, blue collar family background. And they've done very well. They've been very successful, either as an executive in a company, real estate investor, or a business or entrepreneur. There's many different ways that person is involved and many different assets that this planning can be utilized for. Basically, what they do is they transfer an asset up to the older generation. We call it Gen Zero here, or we're going to go upstream. You gift it to your parents or a parent, and on the parent's death, they transfer it down using their estate and gift tax exclusion federally of 15 million. Let's just use one for a single parent, the surviving mother, for example. 15 million to shield the asset from estate and gift taxes federally. Has 15 million of GST exemption to also shield it from the generation skipping transfer tax that goes down to the grandchildren who are Gen 2 here. And there is a calculation of the Minnesota. If you're dealing with an asset or you're dealing with Minnesota estate taxes, you're obviously dealing with that 3 million. So maybe you're dealing with an asset size that's under the 3 million and mom doesn't have 3 million, so you're using that. But as Michael pointed out, I think it's worth the math, even if the asset puts the older generation over 3 million for estate tax planning or state estate tax purposes, your cost basis adjustment and the shielding against capital gains or income tax could outweigh the estate tax, the state estate tax that might be paid utilizing the upstream planning. And so again, it is also the other benefit if it's dealing with really wealthy individuals is if you've got both parents surviving, that's 30 million of federal estate using the DSU and portability and those sorts of things for mom and dad. So those can be very powerful, but that is the framework of this upstream planning is going up the generational level and then back down to the Gen 2 or the grandchildren level. One of the reasons why a lot of times, unless properly, if you transfer it up to Gen 0 and then it comes back down to Gen 1, you're not getting the benefit of the using the exemption because you're just forcing it back into Gen 1, the wealthy family member's estate. And two, under the basis adjustment rules, there could be a loss of basis adjustment if it comes back to the originator down here within that 1 year of the original transfer. So that's why this methodology or this strategy utilizing the grandchildren as the ultimate recipient is the better approach. So that's the framework, that's the basic analysis of it. But upstream planning can be paired with other great traditional gift planning that can really make the estate and gift tax planning and the estate planning using upstream planning that much more powerful. And the biggest tool, I forget who made this joke, so I'll give them credit anonymously. It's not me. They said, if you have a problem and you go to a corporate lawyer, they'll solve it with an LLC. If you have a problem and you go to an estate planning attorney, he'll solve it with a trust. And I probably agree with that because most of the time my solutions are trust-based. But trusts, and those of you that have worked in wealth transfer planning or have families that have trusts know the strength and power that they have. And so what this planning could do is utilizing trusts instead of outright gifts. And so instead of our wealthy family member giving to their parents outright, they put it into a trust of which their parents have a general power of appointment over it. So the rules of the trust that are created by the wealthy family member control, and we get the estate inclusion forced into the parents to use their exemptions and exclusion amounts by giving them a general power of appointment over the trust, which causes that estate inclusion. So that's the great benefit there. And then generally we draft those provisions to say they can exercise it only with the consent of a non-adverse party. So mom or dad aren't going to change the overall dynamic of the plan because that non-adverse party would just not allow them to do that. So you get more control over the assets utilizing the trust. You also get some really good benefits by using trust planning ultimately because you can structure that trust for the grandparent or the parent, excuse me, Gen Zero as a grantor trust. And the reason that can be very beneficial through the grantor trust planning is when the grantor creates the trust, it doesn't exist for income tax purposes. And so all the income tax, again, on if there's income to be earned on it, is going to flow down and the grantor will pay the income taxes at his or her tax rate. And you probably like most of my clients, Chad, why in the heck is the grantor paying the income tax beneficial? And that's because, excuse me, this trust, we're now talking about a trust being in that box, that can grow and appreciate income tax free outside of our wealthy family members' taxable estate. So you get more appreciation growing outside of the taxable estate. And grantor or wealthy family member is paying the tax liability out of estate taxable dollars. So they're reducing their taxable estate by paying the tax liability on assets that are outside of their taxable estate. So in effect, they're making tax-free gifts up into this program to further appreciate or let that growth happen outside of their estate and let the parents' exemption and exclusion amounts cover that appreciation for it. The other benefit of a grantor trust utilizing that is a power of substitution. That's a common tool you utilize with grantor trust of what if that asset, let's say some business stock, low basis business stock was used in this plan and the trust is up here. All statistics would say older generation more likely to pass away first, and so that they will get that cost basis adjustment or step up at the parent's death. We can't guarantee that in life. Maybe our wealthy family member or lower generation person is gets sick, gets a terminal, and so they are the ones that would pass away first. Using a power of substitution, the low basis asset could come back down to our Gen 1 to be able to keep the cost basis benefit adjustment at death. But new assets, higher basis assets, can replace or substitute in the trust. So using the trust allows you to have more flexibility in case of scenarios we cannot predict when we implement or start these strategies or planning. The other tool that trust can be very helpful is in the right design as they come down. And so the design here being the trust, we set up a trust where the parents have the general power of appointment. They don't exercise it, but it's included in their estate for estate and gift tax purposes. The newly stepped up basis assets remain in trust because no power has been used, are shielded by the parents' exemptions, and now the grandchildren, or Gen 2, are the beneficiaries of the trust. But if properly designed, that trust could go for Gen 3, Gen 4, Gen 5, and be multi-generational because you've shielded it using Gen 0's exemptions. And so that multi-generational planning utilizing Gen 0's exemption can significantly reduce transfer tax repercussions for this family for multiple generations. Minnesota, we just now have 500-year trust that can long or trust perpetuities. And so we have much longer durational trusts that can happen here in Minnesota. We go next door to South Dakota, they have perpetual trusts. They can last forever. So this could go on and on for significant generations. And so utilizing that trust and thinking about multi-generational planning in this upstream planning can just compound the benefits to the family over multiple generations. And then with that trust and picking appropriate statuses, you could look at jurisdictions that are maybe tax favorable, like a South Dakota, a Wyoming, and those sorts of things for state income tax planning, and situs the trust in South Dakota to avoid state income tax into the next generations for the future. Because you deal with the income tax in the cost basis adjustment or the capital gains tax, but there'll be ongoing income earned by these vehicles into the next few generations, and probably more in a state like South Dakota. And so if you're dealing with and saving in Minnesota 10% state income tax year over year, that could have significant power as well using trusts. Other key components in the planning is valuation of it. Because if you're looking, and I apologize, I'm flipping a little back between my screens, but I think it's important to do it while you're seeing the flow chart, is a valuation discount. If we utilize this plan and we said, okay, you're going to gift $1 million up to Gen 0 or into a trust for Gen 0, and then it'll run through their estate. Well, Gen 1 still has to use $1 million of estate and gift tax exclusion amount. They don't have to use GST exemption, so they preserve $1 million of GST exemption, but they're still using $1 million of their estate and gift tax exclusion amount federally in that planning. So when we are doing this structure or thinking about this structure, a lot of times we're dealing with minority interest in business. We got a wealthy business owner that has no basis and they're looking to maybe generate basis for a future sale. And there could be a capitalization of voting and non-voting stock, or it might not, but maybe looking to utilize a minority business interest. Fractional interest in real estate, commercial real estate, fractionalizing the ownership to where it's not owned solely by one, but maybe by a 30% piece of that fractional interest, or a family limited partnership wherein you've got liquid portfolio, but you use the family limited partnership and put the liquid assets in it. Now you own an illiquid partnership interest and not Apple stock or publicly traded securities. And so using those assets or those structures to get non-marketable and non-controlling interest discounts, we call it lack of control and lack of marketability, can really leverage this initial gift up here, going from Gen 1 up to Gen 0 or a trust for Gen 0. And so the big key there is, my example would be, you've got a business interest. The total enterprise is worth $3 million. Gen 1's not going to be greedy with his or her planning and says, I want to plan for a third of that. I want to transfer a third of my business interest and get it into this structure as a starting point. So you transfer a third of the business interest up to the trust for Gen 0. Well, you would say, well, Chad, a third of 3 million is $1 million. I can do the math. That's pretty simple. But with that lack of control and lack of marketability discounts applied, that $1 million is not just, it's just not a straight pro rata analysis. Many times we're seeing discounts in the 30% range, depending on different factors. But let's say it is a 30% discount. That gift of $1 million or a third of a $3 million company for estate and gift tax purposes is $700,000 because you have a 30% discount that would apply to that. And you've now leveraged or preserved $300,000 of estate and gift tax exclusion amount, which, using a combined blended estate and gift tax rate of 50% for federal and Minnesota, that's roughly, when you take in deductions and consideration, that's $150,000 estate tax savings by utilizing that discount. And so, because 50% of the 300 in the discounted value that you've shaved off or leverage. And so you can extrapolate that well into the future or into the higher amounts using my simple example. But those discounts in this initial gifting can really be powerful in leveraging the exemption or exclusion amount of Gen 1 here. The other is incorporating other common estate planning strategies in order to be able to further leverage the exemption. If, for example, Gen 1 is very wealthy, he or she is the one, and says, well, I can't use a lot of gifting or exemption or exclusion amount in order to get this going because I need my full 15 million to preserve and cover other assets because I have significant assets. Instead of making this a straight gift, even a discounted gift, the transfer up to the trust for Gen 0 can be structured multiple ways to preserve the exclusion amount of Gen 1. For example, a GRAT or grantor retained annuity trust, in which the Gen 1 puts assets into a GRAT, receives an annuity paid back to them over a term of years, and the appreciation or assets in excess of the annuity amount would come up and get paid up to the Gen 1 or Gen 0 trust. The benefit there is you can structure GRATs to be zero remainder interest. So you use no gift and estate tax exclusion using a GRAT. And if you beat the then interest rate in appreciation, which many times real estate and small businesses are exceeding the interest rates, that appreciation goes on with no estate gift and gift tax exclusion amount being used into Gen 0 pool. That it can be a great tool in funding this and preserving Gen 1's exclusion amount. Another tool is the installment sale concept. And here, I'll flip to another slide so you can see that, is instead of, again, making a pure gift up to the Gen 0 trust, Gen 1 sells the assets into Gen 0 trust. Now, not to get into the minutia, but there probably has to be some gifting component to get some assets to put some value into the Gen 0 trust for the sale. But let's just presume we can do this, or there are some assets that have already been gifted into it. But Gen 1, instead of gifting that 1/3 of the company, they sell 1/3 of the company into the trust. This is a very powerful tool as well because many times Gen 1 might be younger. They might be in their 40s or 50s and they have a long life that they want to continue to live. And they don't want to say, I just want to give away an asset and not get anything in return on it. And so if they sell the asset into the trust, and it could be at that discounted value, so you're shaving off their estate value, they get a promissory note back to them. So again, on my straightforward example, a discounted value of that 1/3 interest, you move in $1 million gross into the Gen Zero trust. You take back a $700,000 note that gets paid off over years. We structure them multiple ways. We can amortize it. It can be a balloon where it's interest only. But what you've done here is you've frozen Gen 1 at the applicable federal rate is the interest rate we commonly use. So we've frozen their estate at that 700,000 plus interest, and we shifted the 300,000 discounted amount plus any appreciation in excess of the interest up to the Gen Zero, and then it falls into line just like our other flow chart. Gen Zero passes away, the assets pass on to our Gen 2 trust or for the benefit of Gen 2, and you get the new cost basis step up, and the asset can be sold for no income tax consequences or estate and gift tax consequences, assuming they're below federal and state rates. Now, you're also going to probably be asking, well, Chad, you're talking about a sale going on here. Isn't that going to trigger gain? And you defeated your purpose here. The benefit of that grantor trust is a sale between a grantor and grantor trust doesn't exist for income tax purposes. It is it is the same taxpayer from an income tax standpoint, and so that tax is there is no tax that occurs there, and this asset or this trust will have a carryover basis in it, and there is no capital gains tax on the sale. And the promissory note interest payment, similarly, no income tax consequences there. The last one this is a non-exclusive list, but another strong tool that can be utilized, maybe not so much for cost-based adjustment at death, but for qualified small business stock, QSBS. It's quite a bit of the rage a little bit right now in income tax circles, particularly with the passing of the big beautiful bill last year and the increase from 10 million exclusion of gain to 15 million. And very quickly, basically, if you have qualified small business stock, you can exclude when that stock is sold up to 15 million of capital gains on that sale if it does qualify for this QSBS. But that's per taxpayer. So what we are looking at, and many people do, is we stack and find new taxpayers, and this is upstream trust planning can be utilized in that by instead of making the upstream trust or Gen Zero trust a grantor trust, it could be a non-grantor trust. You've got a new taxpayer who could qualify for up to 15 million exclusion. So when the company sells, you've got Gen 1, 15 million exclusion, the Gen Zero trust, 15 million exclusion. You can exclude 30 million of gain on this qualified small business stock and using this stacking concept in upstream planning. And so I went through a lot of different structures and strategies, and there again, this is non-exclusive. So it's really analyzing this together with the other advisors, the CPAs, because it involves income taxes, it involves working with the estate planning attorneys, it involves working with the business attorneys or business advisors, if it's a business, and those sorts of things. But this is just the planning side of it and the implementation. We all know the devil being in the detail. Many of these advantages can get lost or messed up or defeated when we move into the administration. How do you keep this up? How do you keep this going for the benefit of the family? And Chad's going to talk to us about how that can be beneficial or how that can happen.
Thank you. Appreciate it. One thing I wanted to reinforce that Chad said quite well is just the value of team. this is a multidisciplined approach. It requires specialists in different areas, as hopefully we've expressed today, on the tax side, on the investment advisory side, on the trust side, and on the legal side. So, this is not a one-size-fits-all solution for everybody. We strongly encourage you to meet with your trusted team, or us if you don't have a trusted team, and talk about your current scenario, because everything we talk about is customizable. We have to look at what your facts and circumstances are in order to get you the right solution. This is a very unique solution, but one that can be very effective for the right client and the facts and circumstances. So again, focus on team. The other part that Chad was talking about was the administration, and that's where a corporate trustee could come into play. A lot of our clients really have three choices, I guess. They can have the assets distributed outright to them, to their children, or to Gen 2, or even up to Gen 1. The other option is to have a trustee and to put these in trust. There's still options there. You could have a family member as a trustee, or you could choose to hire a professional trustee. And where we want to make sure we communicate some of the benefits of the corporate trustee does this every day. The corporate trustee has professional management skills, understands tax laws, understands investment strategies. So it's important that you think about if that's the right fit. The other side of this is the professional trustee doesn't have a lifetime, I should say. So if you choose, your brother to be your trustee, his lifetime isn't that much longer than yours. Or if you choose a child to be the trustee, you've got another generation there. But as Chad was saying, if we're talking about multi-generational wealth, he's going to hit his expiration at some point too. So having a corporate trustee that has an infinite life might be an interesting option. Also, when you choose a corporate trustee, you have flexibility in choosing situs. Chad alluded to this as well. Different jurisdictions have different rules. Some jurisdictions have more favorable rules in different areas. Chad was referencing how South Dakota has an unlimited duration. So a trust in South Dakota could go on in perpetuity. That's one benefit. Another benefit is they have really flexible decanting rules. So if an irrevocable trust needs to be modified for a reason that fits within the parameters, South Dakota law and South Dakota courts are open to looking at that. There are obviously facts and circumstances that have to be considered, but it is a trust-friendly state. Asset protection also is a really big, important piece. We think of asset protection as, making sure we protect the assets for our beneficiaries. One of the biggest issues with asset protection is marriage. A lot of our clients really want to ensure that these assets stay within their family. And while we hope all of our children never get divorced, we hope that they stay together. Statistics suggest otherwise, and it's likely that someone in your bloodline will have that experience. So being able to have these assets in trust, protect them from a divorce or other litigation matters, can be really important too. And then one other key benefit of state selection or situs selection is states like South Dakota do not have a state income tax. So Chad alluded to this earlier in his conversation, but there may be some real meaningful benefits if you look at the rolling tax benefits year over year to not having to pay tax at the state level on undistributed income. There's probably years and years of value and benefit there. So as we think about that, having a team put this together, think through this with you, I think adds a lot of value. And as I work with clients, it's rare that the strategies are the same. Every client comes with different components, either different businesses, different assets, different family dynamics, different needs that really make it challenging. One thing that just hit me as I said that, family makeup is a big part of why a corporate trustee may really be good. We see a lot of blended families. We see families where the surviving spouse wasn't the mother or father of the children who are the ultimate beneficiaries. Then we have some concern or potential conflicts of interest between, that surviving spouse's kids versus the decedent's kids. And having an impartial third party can, in a lot of cases, add a lot of value too. So I think those are the big points I wanted to talk about estate administration. We would love to have a conversation with you if you have questions about this. If you don't have a team either on the legal side, check in with Chad. If you don't have a team on the accounting side, check in with Michael. If you don't have a team on the trust side, check in with myself, and we'd be glad to continue the conversation. I only had one question that came up during our conversation. It was related to DSUI. And really what that is, I'll let Michael answer it, but really what that is just, it's that portability function in Minnesota. Michael, do you want to add any more to that?
Yeah, so well, it'd be the portability for federal. So if and in the example, like let's say that um, this the decedent's unused exemption. Let's say that Chad provided an example of 3 million going into a family trust. So let's say husband passes away, he's got $10 million of assets. 3 million goes into a family trust. So you're looking at what he's using. 7 million is going to the marital trust. But so for Minnesota estate tax purposes, he doesn't owe anything because you get the marital deduction for the 7. 3 went into the family trust. But for federal purposes, he still had 12 million because he had 15, 3 million went to the family trust, so he's got 12 million of exemption remaining. That would be ported over, so that is the decedent spouse unused exemption. He didn't use 12 million of his 15 million. He only used the 3 that went to the family trust. So he would have 12 million that would then get ported over to his surviving spouse. So then when the surviving spouse passes away, she would have her own exemption plus that 12 million that was ported over from her husband. And keep in mind that you must file an estate tax return in order to show that portability amount for federal and showing the portability and that DSUI amount.
Perfect. One other thing that came up is, Chad, if you can pull back up the slide where it goes Gen 01 down to 2.
Yep.
Asset selection is a really important part of this discussion too. When we gift assets in a strategy like this, what we gift up to parents, we typically want to either have the lowest basis so that you can get that cost basis adjustment benefit, and or the highest appreciating assets. We want to freeze as much value out of generation 1 as we can, allow the growth to happen in another generation, and hopefully we can utilize their full exemption amount. So that marginal difference between what you gift and what the actual value is at death of generation 0, there's a big margin and a big spread there. So with appreciating assets, highly growth focused assets, you even get more leverage in that too. So a lot of things that we want to think about and talk about when it comes to a client's asset makeup, whether it's traditional assets that are more risky or whether it's business or non-traditional assets, all things that I think are really important to personalize for this plan for the individual families. Anybody else have anything? Michael, Chad?
No, I think and I think as planners, I think too keeping that ability of flexibility in it, that's trying to work that, I think absolutely is a strong tool, particularly if we're talking multi-generational. And so as if you're an advisor and you're thinking about these complex or more advanced strategies, always be thinking about those sorts of things. Chad, you're absolutely right. Decanting or trust modifications are a strong tool. That power of substitution I mentioned earlier, thinking about those and how you don't want to try and lock yourself in it for situations you can't plan for.
Right.
And the only other thing that I mentioned, I think I wanted to touch base on was, Chad Carr had provided some examples on a grantor trust and paying the income tax. So that is not you do it one way, you can't modify that. So you could have a grantor trust in the beginning and then you may get tired of paying the income tax. Well, you could remove that power, which causes grantor trust status, and make it where it becomes a non-grantor trust, and the trust then would pay its home tax. So there's all that to say is there's a lot of ongoing planning. There's a lot of things that could be incorporated to ensure that the things that you want and maybe some issues that you may have with it can be kind of mitigated in a lot of circumstances.
Yep. Well, thank you all for joining us today. Look for upcoming webinars and presentations from us, and I hope you have a great rest of your week. Thank you.
Thank you, everyone.